Meta had earnings today, and I wanted to take a look and see what the fair value is for the stock, some growth prospects, and what a decent point to get in would be, because growth looks pretty good here, but the price does seem to be pretty high. It did take a pretty big pullback off of these earnings, and we're going to see if it's going to pull back to an opportunity to get into the stock. So coming up with the fair value of 336.5, discounted cash flows 365. So clearly in the low 300s is really where we'd like to be. It closed today around 490, and then after hours, it tanked to 440. Earnings yield, all of this is based off that 490. 5.81%, so we'd want them to come in with an EPS around 24.5. And what we're actually seeing from them is 20 expected this year, 23.20 next year. So clearly, valuation is a little elevated there. Cash flow yield is incredible. Came in at 32.5 this last year, usually around 28.5, just north of that. So great cash flow stock. Dividend, they just started paying this year. They're going to pay 50 cents. We'll see if they keep that up and at what rate they're going to raise it. Not really certain right now. ROE, 25.53, and that's not diluted. Their debt to equity is one of the better ratios that we've seen. That is a green flag for once. Usually we don't see that. ROI, really good, almost 19%. ROA, 17%. So across the board, amazing. Definitely growth stock here. Really good returns for everything there. Gross margins, almost 81%, typically around 80. Net came in a little high this last year, just shy of 29, usually 27.8. So just shy of 28. Incredible margins. Usually we're looking for 30-10. 80-30 is incredible. So now we need to put together a thesis for the stock to help determine where it's going to go. So analyst projections are putting it 17.5% growth in revenue this next year, and then 2 years out, 15.14. So 16 for the thesis might be a little high. Seems like they're looking at a bit of a pullback, but we'll start with that and see what it gives us. Share count, they do buy back shares, usually at least 2%, so we'll stick with that 2% figure. Cash flows, we've seen good growth over the last 2 years, kind of all over the board. Really what we'd be trying to do is get their average cash flow yield maybe a bit higher, so that'd be 14%, just a little bit less than the growth that we're seeing in their revenues. And honestly, it might end up being a bit lower than that. We'll see if they can hold at these higher levels. Assets, they're growing double digits, definitely picking up more recently. This is always a hard one to figure out. 17% doesn't seem like it'd be too bad. And liabilities in the same way, 23 and 27.4. So 25 is what we'll use for the thesis to start. Dividend, hopefully they can grow at least double digits. Even this 10%, right now they're paying a payout ratio of 13%. So they have a lot of room to grow it. If they grow it at 10% in 5 years, we'd be looking at a dividend of north of $3, a 0.7% dividend yield on cost. I'd like to see that at least 1%. So maybe if we up this to 15, now they're paying $4 in 5 years, still only 0.8% yield on cost. That's because you're at a pretty high price right now. You'd want to get in a bit lower. It did go to 440 after hours. So let's take a look at that. I'd give you a 0.9% yield. So what if they grow this in line, if not outperforming revenues? There you go, 17% right there. Now, this thesis here definitely seems to be very reasonable, and we'd be looking at average annual returns of 16.75. Once you factor the dividend in, you're looking at 17% year-over-year growth in your position. So definitely looking like a good one here. One of the better stocks that we've seen. Although even buying it at the current prices you're underwater in 3 years, and in 5 years, you're underperforming the market by about 18%. So clearly, it's one of those growth stocks that's trading at future valuations. It looks like it's trading somewhere in the realm of 3 to 4 years out. And if we can keep it on a watch list and the thesis stays consistent, but some other things, maybe with the whole economy or maybe even something within the company that doesn't really affect these numbers, we can get a better buy price because it has been as low as 207 in the last year. And for anyone who bought at 207, they are sitting very, very good. 4 times market returns in the 3 year, nearly the same for 5 year. Definitely sitting very well on that position. It's been as high as 531.5 within the last 52 weeks. And I would not want to be one of the people who bought at that price because I don't think that you're going to see any sort of returns on that investment anytime soon. I mean, even if this thing is trading at 3 to 4 years out, you might be looking 1 to 2 years before we're reaching those levels again, assuming that this is true and that there's no other company that's going to come and take some of the market share and get these revenues to slow down in the next 5 years. Definitely possible. Not the biggest moat. It would definitely be a no-brainer at 300 or below. Again, assuming that you think that this is what is going to happen. Let's say that revenues do slow down quite a bit. Now you're still looking at very good returns. Share counts, I mean, the valuation is pretty elevated. It has like doubled in the last year, so maybe we have that. Cash flows, if we take that down to 9%, it's more in line with the average. Now we're still looking at good returns here. Asset growth, they did pick it up, but if we go to the lower end of what we've seen, 11% there. Liability growth, if we go to the upper end, like we're trying to come up with a worst case scenario, at least from what we've seen in the past 3 years. Dividend growth, it's not going to have a massive impact on anything. Let's say that they actually don't raise this dividend at all. And margins, if margins hold flat, you're looking at returns in line with the market here. That's probably worst case scenario, at least based off what we've seen in the past couple of years. I mean, if their margins do shrink, it might be a bit more painful. 5% per year takes them down to 22.4 in 5 years, which is still really high margins. And now you're underperforming the market. And even that $300 price doesn't look as enticing. There you go. We took a look at what's a reasonable case and what probably more of a worst case scenario would be for the stock. And I mean, if the worst case were to happen, that's why we try to build in this margin of safety, where even given the worst case, if you can get in it at 225, which it's been that low in the last year, you're still looking at outperformance on the 3 and the 5 year time frame with this stock. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at and subscribe so you can stay up to date with everything. And I'll catch you next time.